Hello everyone. So today I'll be talking about interest rates and housing prices and how they correlate with each other. And I'll be starting from 1975 and ending at 2021 at 5-year increments. However, the last year can't be a 5-year increment because we're not in 2025 yet. So it's going to end at 2021. So let's start. So this part here is the Fed fund rates. This is what the central bank or Federal Reserve sets the interest rates, and these here are the mortgage rates. So in in practice, the mortgage rates are always higher than the Fed fund rates because this is what the banks and lending institutions borrow the money at, and they lend it out to you at these rates if you borrow money from the lender, the bank, or something like that, or lending institution. So this here is the average housing prices from 1975 to 2021. So as you can see, the Fed fund rate was about 5.82% in 1975, and the average housing price was in the United States. So this is the average housing price. This isn't, let's say, the housing price in New York City, Manhattan, San Francisco, Los Angeles, or some major city like that where you have real estate prices which are much higher. But this is just the average housing price. So in other parts of the country, let's say like in the Midwest, the housing prices would be much lower. So it's just the average. So throughout the United States. So here, this is how much housing prices cost in 1975 average. A mortgage rate was about 9.43%, and in 1980 the interest rate was 13.35%. For some reason the mortgage rate here is lower than the Fed fund rate. Average house price was $55,074.15. So if you look at this in context, I think in 1971, the U.S. was no longer using the gold standard. Okay, in 1971 it ended. So basically, from 1971 onwards, the money isn't really anchored to gold at I think it was maybe $35 for an ounce of gold, yeah, I think so. U.S. gold standard. I don't really remember the Bretton Woods agreement. So it pegged 1 ounce of gold at $35 an ounce. Okay. So that ended in 1971 with President Nixon. So money was just tied to GDP, the gross domestic product, and the GNP, the gross national product, and production basically. So it was all dependent on supply and demand. So if the economy produced a lot of stuff, then the prices would be lower in the economy, which signified a stronger economy. Okay, so as you can see, that as the years go by, the Fed fund rates started to decline, as you can see in this graph right here from 1975 to 2001. It declined like that, which you can clearly see in the charts and in the graph. So The y-axis represents the percentage of the Fed fund rate, and the x-axis or horizontal axis represents the years from 1975 to 2001. So it's been going down steadily. And as you can see, the price of houses started to go up. The average housing prices, or the average cost of a house from 1975 to 2001. So that's basically the trend. So the interest rates, whether that be Fed fund rates or mortgage rates, and housing prices are kind of like the inverse of each other. So when one goes up, one goes down, basically. So the mortgage rates from 1975 to 2001 has also been going down, right? As you can see on this graph and also on this chart. So I guess interest rates were very high in 1985 when Paul Volcker, who was chairman of the Federal Reserve, started to hike up interest rates in order to fight the inflation of the 1970s, and that brought inflation under control, basically. So that's how they brought inflation under control. So but housing prices nevertheless kept going up, even with interest rates being high. It didn't really go down. So they lowered interest rates a little. Housing prices still go up, still go up, still go up, still go up. I guess in 2008 we had that financial crisis, so you had a dip in housing prices as a result of it. But then, in order for in order for the government and the Federal Reserve or central banks to combat this, they just had to lower the interest rates, right, to prop this back up. So that kind of like stimulated the economy. So in 2015, interest rates were very low, but housing prices still go up. See, but it makes sense. So when interest rates are low, that will encourage people to buy houses, even if they are a little more expensive. Well, actually a lot more expensive. And I'll explain this later. So interest rates are low here, but prices still go up. It's gone up a little bit. And then they dropped interest rates again, and prices of houses are very high right now. Very sky high in 2022. And so when you buy a house, you have to make a down payment, right? So with this chart right here, this is a year, this is a down payment for the house based on the price of this. So down payment is 20%. So if you bought a house in 1975, you would pay a down payment of $6,406.70 for a $32,033.50 house. Okay, and that will come out to $214 a month. So the total amount of money you would pay is $77,040 in a period of 30 years. So this is based on a 30-year mortgage. And well, every year the amount of money that you would pay for the 30-year mortgage went up because the price of housing went up, right? That's obvious. Of course, the monthly payments would go up as well, but the monthly payments are a lot less than what you would pay for rent. And also, when you buy a house, you have to consider property taxes and stuff like that, so you have to add that in. But I didn't add this in this chart. But you do have to pay property tax as well when you own a house. There are certain obligations you have to have when you own a house, like you have to mow the lawn and you have to maintain the house, like painting it and stuff like that. That's also a cost. You have to have some home insurance and stuff like that. But I'm just talking about the price of houses. So the down payment for the house has gone up considerably. So for a $342,000 house, you would have to pay about $68,000 in down payments at 20%. So the question is, if you bought the house and paid for it in 30 years, is it worth it? In a, in my opinion, I think it is worth it. It is worth buying a house and holding it for 30 years because you don't have to pay rent. Um, and you can't get kicked out. You know, you could live in your house, and it appreciates every year. It's like an asset. As you can see, the price of houses just keeps going up. But there are times when the price of housing does dip a little bit, but it always goes up. So you really can't get it wrong, you know. And it's something that you're using, unlike a car, which is a asset that depreciates over time. Real estate is not like that. Real estate is something that appreciates over time, you know. And if you own, let's say, apartment building as an asset, um, yes, the rents go up every year as well. So it's definitely the best type of investment around. I think it's better than it's certainly stable. It does have uses. It's generally a good investment. So let's look at if I bought a house in 1975. This is what I'd be paying in total, and now the house is worth $342,844. So how much money would have I made? So we'd subtract the 30-year in total, 77,040 minus six down payments, 6,406. So I would have made 259,000 just holding this house, you know, if I bought it in 1975. So what if I bought the house in 1980? How much would have I made, you know? I would still be $157,949 ahead, you know, if I bought it in 1980. What if I bought it in 1985? I would still be $109,918 ahead. So, as you can see, in the period of, let's say, 1975. So let's see how many years ago that was. I think maybe 46 years, okay. In 46 years, houses went up. 10.7 times, right, in 46 years. So let's see how much it went up in 30 years. In 30 years, let's see, 2005. 30 years, a house will go up 5.98 times. So let's try to predict how much a house would cost if you bought it in 2020 in 10 years. In relation to this, it would go up 2.13 times. But let's see how much it would be from 1980 to 1990 in 10 years. Okay, 1.76. We'll average the two, so let's say it would go up 1.88 times in 10 years if you bought this house at this price. Okay, so you'll still be ahead. Um, like I said, there may be times when housing prices go down, but right now, what we're seeing is we're seeing a what we're seeing is that the number of houses that are being built and the supply of houses isn't keeping up with the demand for houses. So more people want to buy the houses, yet and there isn't enough supply for them. So this explains why the price has spiked so steeply from 2020 to 2021. So we have the supply chain problem, right? So house builders or contractors can't get the materials to build the houses, right? So they can't finish the houses, just like these car manufacturers can't get the chips to finish the cars, right? So we're having these issues. So as long as these issues keep continuing, and the demand for houses keep going up because people need houses, um, I don't see a reason why housing prices would go down. I mean, the population does increase every year, and people do need houses. We have a shortage, and we'll have to see how long it takes for them to rectify this problem of creating enough houses for enough people, so the price of uh, housing remains stable. So, anyways, thanks for watching. My